The truth is, sometimes we get comfortable with the ordinary, sitting inside the lines others have drawn for us, when there is an entire blank canvas of a world waiting for us to trust fall into solutions to questions not even asked yet, to rise, revise, and recognize that remarkable is not only possible, but it is necessary. It is the result of daring to imagine beyond this partition of parameters, always onwards, upwards, and forwards, towards the whys of ideas redefined, the what-ifs of partnerships, the how can we improve this. This is more than a common belief that in order to succeed, we must always see details 3 steps ahead. This is not about spotting market trends or hopping on bandwagons, because many others have been there, and quite frankly, so have we. But we are also about people. Shorooq, the right fit in the right place, like perfectly timed happenings matching skills with partners already found, where the sum of parts can create platforms only teamwork lets you reach. No, not you, us. Plural, collective. A home field advantage, expertise meeting the opportunity of what we did, are doing, and will do. Investing in holding open doors wide enough for impact to walk through. So we continue being the outlier, the deviation, the above and beyond expectation, the ones uncomfortable with being ordinary. Today is the day. Join Shorooq Partners.
Welcome everyone to our first episode of our weekly MENAP Venture Debt series, where every Tuesday at 3 p.m. GST, we go live on LinkedIn, Twitter, and YouTube, where we explore a certain topic with you on venture debt, and you can ask us any questions you might have on venture debt. If you're watching this through our LinkedIn, Twitter, or YouTube, remember to follow, subscribe, and click that bell icon to get notified with all our news, events, and updates. This show is brought to you by Shorooq Partners, the leading tech investor in the Middle East, North Africa, and Pakistan. And I'm your host, Tariq Fouad, Head of Growth at Shorooq Partners. And I want to thank you all for tuning in from wherever you are. Today, obviously, we have the pleasure of having our own team, our partner, Samir Yamani, and Nathan Kwon, who leads the venture debt practice at Shorooq Partners, along with our partners. Thank you so much, guys, for joining us today.
Thank you for having us.
And as you can see, a great team answers in the same time. And they both said the same. I'm not sure if I should say jinx there, but beautiful. I love it. Welcome aboard. Guys, I don't think a lot of those seeing us today really know the faces behind our venture debt. So I would love if Samir, you can introduce yourself to everyone and introduce Naha Fund for us, please.
So thanks for having us, Tariq, on behalf of the Naha Fund team. It's a real pleasure to have everybody connecting from wherever you are in the world. And we'll be looking forward to talking to you today about venture debt and over the subsequent series that we have. The Naha Fund is a venture debt fund that was given regulatory green light earlier last year. It was on the back of many years of hard work to really introduce venture debt to the regulators and to our ecosystem. And we're proud to say the Naha Fund is the first venture debt regulated fund out of the ADGM, serving all of our ecosystem throughout MENA. I lead the fund as the partner together with my friend and colleague, Nathan Kwon, and supported by the rest of the Shorooq platform. My name is Samir, and looking forward to answering all of your questions and giving you more insight throughout these series.
Love it. Thank you so much, Samir. Nathan, would love if you could kind of introduce yourself to everyone as well.
Sure. Thank you for having us, Tariq. Everyone, it's great to be here, joined by my colleagues, Tariq and Samir. My name is Nathan. I'm a senior investment professional with Shorooq Partners, and I lead the venture debt fund together with Samir here. Originally, I hailed from Korea, and then I did my undergrad at Yale. And before joining Shorooq, I was working as a VC fund manager outside of Korea. But I saw the potential that this region has and was amazed by the opportunities in this market. And I'm privileged to say that I've been given the chance to disrupt this ecosystem with the region's very first venture debt fund. And I'm proud to be serving you guys and the ecosystem here together with my colleagues at Shorooq.
Thank you so much, Nathan. I want to remind everyone watching us today that these sessions are very, very. They're based on interacting with you. These are sessions for us to actually answer all your questions with regards to venture debt. So make sure to throw your questions into the comment section below. We will try to answer as many of them throughout today's episode and the series to come. Remember, again, this is a series dedicated to venture debt that will air weekly along with our partners, IMM, and the session or the series will be aired on Tuesday at 3 p.m. GST. So book that into your calendars. I would like to maybe start off, Nathan, with a very simple question. It seems, native venture debt is not necessarily a new instrument or financing tool per se, but probably for the region, it is quite new a vehicle, I would say. Maybe if you could introduce and answer for us, what is venture debt?
Sure. So as the name suggests, really, venture debt simply means investing through a debt vehicle into startups. The special and the unique part about this here, though, isn't the debt part, I'd say, but rather the fact that we're able to invest into startups via a debt format, which has really never been tried before in this region, because most startups, as you guys know, they lack the physical assets to serve as collaterals. Most startups in their early stages are also net profit negative. So there's no positive cash flow stream to think of. So that's why the default mode of investing into startups at an early stage has been through equity. But now that with the amount of experience that we have gathered as an investment firm and the projections and the outlooks that we're able to make, we have decided that if we are able to have confidence in the company's growth perspectives and if we can employ some innovative means to provide startups with debt facilities. And the great thing about debt facilities from the startup side is that it does not require the startup to put up any equity stake or a very small equity stake. And this means that you're able to secure additional funding to grow the company and extend the runway to hit your key KPI goals and outlooks before you get into the next equity fundraising round, so that you're able to present a stronger facade for the company and to raise capital at a higher valuation and at a stage when the company is doing better than it would have before. So by combining equity and debt, the startups are able to have access to this additional form of capital, increase the runway, giving the company the time and the resources to meet their KPI goals and raise capital at a better valuation, at a better stage. Now, from the investor's perspective, this also presents an exciting new opportunity to diversify the portfolio. So if by complementing venture equity investments with venture debt, what we can do is the equity side provides that strong upside exposure to upside a couple of years down the road. But by augmenting that with a debt portfolio, the investors are able to enjoy a steady stream of cash flows that comes from the cash coupons. And then also kind of get some small exposure into the companies that we're investing by taking warrant stakes into that. So combining these two provides an attractive way to diversify the portfolio and spread out the cash streams into further investments.
Thank you so much, Nathan. That was quite detailed and informative, and I loved how you went into this from an investor angle or lens, and as a founder lens as well. Samir, over to you. Probably, I want to maybe cover, how different is it from venture capital? One, from a founder's perspective, are we looking into the same that you look for as a VC? Is the same things that you look for from a VD angle when it comes to founders and startups? And from a investor standpoint, what is the difference when it comes to what is expected from funding a venture debt fund, for example, or being part of a venture debt fund?
Yeah, great question. So I'll answer your questions backwards. So on the back of what Nathan said, an important feature of venture debt also is the underlying security that we have with the transaction that we engage with the companies. So what that means is our venture debt sits above the equity holders from a security perspective, so that there is a lot more downside protection than a pure equity play. Really speaking, the venture debt piece is supposed to augment and support the venture capital investments coming into the company. So this can be from extending runways to providing different uses of funds through the venture debt play. When it comes to assessing the companies, ultimately, when we look at a company, the basic fundamentals of our analysis into the companies are not different from that of a venture capitalist. Ultimately, you want strong founders, you want strong teams, you want strong theses with supporting fundamentals. But on the venture debt aspect, we look at a lot of other things, from the underlying security to the ability of the company to service their loan going forward, and the projections of the company going forward, and how they will be able to also not just service the debt, but amplify our warrant pieces, which we may have during those agreements that we put in place.
Here, a quick maybe follow-on question, and I would also like to remind the audience, these are short series focused on answering one or two questions, and we rely a lot on your questions. So feel free to again throw in your questions in the comments below to guide us and to guide Samir and Nathan on answering those. We would go deeper in a subsequent series or episode, I would say, on exactly what you just said, Samir. What does it mean for a startup to be able to service their loan, right? What does that mean when it comes to their books or to their financial statements, for example? And how do you actually gauge that? So for those watching us, stay tuned for next week's episode, as we kind of cover that in a little bit more details. Now, it's very clear that these are kind of two different instruments or financing tools in a way. Would there be, from a startup perspective, a certain, I would say, trends or insights that you can share that you say majority of those who go to venture debt are in a certain stage or a certain size, for example? Would you say so, Samir?
Yeah, so I mean, ultimately, the CFO in these companies need to ascertain if they're actually able to service a loan. So taking a loan is a big responsibility for any startup. From a security perspective, you're putting a lot on the table in case things go bad. And so for a founder who's been putting a lot into their company, putting their whole lives to set up these companies, they really need to think very carefully when they're engaging in a venture debt conversation. And what I mean by that is that number one is their ability to service the loan. Number two is the security packages that they're actually able to offer. And with a lot of founders, sometimes they think venture debt is more of a distressed loan facility. And that's typically not what we look at in the Nahda Fund. We look at leading companies who are dominating their verticals. And for the CFO, there's a variety of things that they need to consider, from overall cash flow management to servicing their coupons on a quarterly basis, all the way to the dilution effects of adding the venture debt piece to their overall liabilities. And accordingly, they need to right size what that agreement actually looks like and the type of funding that they may need. On our end, within our region, a lot of these startups are operating in a lot of different geographies, and each of those geographies have a lot of different risk profiles, from sovereign risk all the way down to currency and political risk. And so what you may find is that there might be specific carve-outs that us as lenders may want to look at. And so there's a variety of things that the CFO and the founder would need to look at when engaging in these conversations to ascertain if this type of instrument is really right for them. What we look at the Nahda Fund specifically is, strong GMV growth, for instance. We look at exactly how they're underwriting this particular transaction, from receivables to a variety of other, asset-backed options that they may have. So quickly speaking, from a venture capital perspective, it's quite quick. It's often quite uniform. You have safe notes. Whereas on the venture debt team, we really go very deep into the company and customize our instrument specifically for that particular startup.
Beautiful. I love that. Thank you so much, Samir. You guys are doing great. We obviously had Ahmed Gourani, who kind of joined us way early before starting, and thank you so much, Ahmed, for supporting us. Nabil is a great friend for Shorooq Partners, and he loves the passion that is in the panel. So well done on you guys. Give yourselves a pat on the back. And I think he had a follow-on question that maybe really did, Samir, I think you really tapped into where he asked, how early do you invest in venture debt, right? Do you see pre-launch companies apply? In fact, we have Arwa, who actually asked a very similar question. Can pre-seed companies apply to venture debt? I think you touched upon this, Samir, with your answer, but maybe Nathan, in your experience with venture debt, have you ever come across pre-seed companies getting venture debt? And if not venture debt, have you come across them actually getting debt as a financial instrument in general?
So to cut to the chase, typically pre-seed and seed companies don't apply for venture debt investments, or rather, should I say, don't qualify for venture debt investments. Normally, we do look for companies who are in Series A stages and beyond, and those who have at least raised $10 million of previous capital. And the reason we do that is, as Samir pointed out, that taking out a debt is a huge responsibility for the company. And we want to make sure that we do two things before we actually provide debt investments. One is to gauge whether the company has previously shown that they have the ability to manage financings and liquidity. Because like equity, where the valuations just happen naturally as the company grows, with that, there's always a portion of a cash coupon that needs to go out regularly, and that requires management of cash flows. So we would like to see the company and also the finance team within the company has had a track record managing that cash flow stream, and also in a way that doesn't harm the company, right? So these the idea, or rather the purpose of providing that, is to help the companies in the end. And I think that is one stigma that I really kind of want to banish, given the regional kind of setting. I think there is still a little bit of a negative outlook on debt investments. I do want to emphasize that is not the case. And the reason we provide venture debt is so that together with equity, it provides startups with additional means of financing. And the situation that we really want to avoid is by getting venture debt, the company would actually be in a riskier position than before. So that's why we do screen for the stages and the previous amount of fundraising that has happened before.
Lovely.
Just to add a little bit to that, I can see there's a couple of guys with a a lot of financial background that are joining the panel. So if we look at the distribution of venture debt, typically by series, so typically around 47% that actually get venture debt around the Series A stage, and that tapers down to Series B, C, and D. There are, about 8 to 9% generally of companies at the Series seed stage applying for venture debt. But the reason why typically it's happening around the Series A, Series B stage is because the impact of venture debt on the company and the cap table going forward from a valuation perspective is usually highest. So that's why, on the back of what Nathan said, we generally see, and also statistically, you'll find that Series A, Series B stage is where the highest impact of venture debt actually occurs.
Great. Thank you so much for that, Samir and Nathan. And thank you, obviously, Arwa and Nabil, for your questions. These sessions and episodes are purely to kind of make sure that everybody in our ecosystem, and specifically founders, are aware and get their questions answered, I would say, and for them to kind of know who to tap to, at least within the ecosystem, for them to get answers with regards to their funding and series of funding, I would say, they go through. So appreciate all the questions, regardless of how small you think it is or how complicated it is. And we will kind of dig deeper into many of these as we go throughout every single week. Please remember, if you're watching this, to follow us at Shorooq Partners. So that is at Shorooq Partners. We are on Instagram, LinkedIn, YouTube, and Twitter. And just follow us, like us, subscribe to our page, so then you can get all the news and the updates. Next week, we are going to cover what we look for when it comes to a startup, dig deeper into these KPIs, and how does this due diligence work, right? What this path looks like, or that process looks like. Lastly, remember, if you're a startup wanting to fundraise, or you're raising a VC round or a venture debt round, remember to visit Shorooq.com today, press on that Get Funded button, and your application goes right to the investment team that looks into your application and gets back to you with feedback right away. Appreciate everybody that joined us today, and obviously my colleagues Samir and Nathan for a very quick and informative session on venture debt and how different it is from venture capital. From myself, Tariq, Fouad, and the Shorooq family, appreciate your time and have a great day.